So another item in the contract is the mortgage contingency. So we've discussed this in a prior video, but just a quick recap. It's a term that can be negotiated between the purchaser and seller, and it allows for the purchaser to back out of the contract if they're not able to obtain an agreed upon amount of financing to purchase the property, so long as all the conditions are followed. And it is worth noting that a mortgage contingency, the terms of it can vary from contract to contract. So I would advise that all purchasers make sure you understand your specific mortgage contingency and speak with your attorney about how you can follow those guidelines and requirements, so that if you find yourself in a situation where you needed to use that protection, you're able to get your 10% down payment back, and that you didn't violate any other sort of restriction in your specific contract. In the contract, we typically see a common closing date of 60 days from the date a contract is executed, an on or about closing date of 60 days, I should specify. And that means that once the contract is executed, once day 60 rolls around, that's when the parties should be able to schedule closing if everything has gone according to plan. If either of the parties are in a rush, what can happen is after that 60-day period has come, on day 61, either party would be able to send out a time is of the essence letter saying that they are ready, willing, and able to close under the terms of the contract, but the other party has not. And that letter typically is a 30-day notice, so an additional 30-day from an on or about date that would essentially force the other party or put them on notice that if they don't close by that end of that period, they either, if they're the purchaser, lose their down payment, or if they're the seller, they're going to terminate the contract and refund the down payment to the purchaser. So both parties really have that option to be able to put an end timing to where the contract goes. So that's when we have a mortgage contingency in place. We have that on or about 60-day time period. When there isn't a mortgage contingency, so the parties may be able to have the funding up front and be able to close all cash. Sometimes we'd be able to close as soon as 30 days or 45 days. That's going to be a shorter time period if a seller is maybe in a rush to sell the property. They may look for a purchaser that doesn't require a mortgage contingency, or a purchaser that is putting as a part of their offer that they have those funds readily available and they'll be able to close in as soon as 3 weeks. So that may be a big pro to someone who's looking to negotiate the terms of an offer that they're submitting to a seller. So once a contract is signed, from the contract signing period to closing, if we take out the considerations of a lender being involved and them having to underwrite the loan from their end, what else happens between the contract and closing? Once the contract is signed, we order a title report from a title company. And what the title report will show us is essentially a chain of ownership that goes back from the current seller to include all previous sellers and owners of the property. And they need to make sure that there are no outstanding liens or judgments, or maybe even older mortgages against the property. And if there are any outstanding liens and judgments, they need to be satisfied and paid off or dealt with in a way that's acceptable to the title company prior to closing, so that when, as a purchaser, you purchase the property, you're getting a property that's free and clear of all liens. That's what the title company is essentially doing. They are going to ensure that you, as the purchaser, will be able to have this property free and clear of all liens, and that no one else is coming out of the woodworks with a surprise judgment that may be attached to the property, a long-lost relative of the seller that is making claim to the property. And if any of this does happen, then the title company will step in and they'll defend your rights to having the ownership title to the property. In addition to a title report, what is also happening between the contract period and closing? For example, if you're purchasing a single-family home, you're going to also want to get a survey done. So a survey is going to essentially show you the bounds of your property, where the fences are, any sort of lot lines, if there's any easements. So there are a lot of things that a purchaser may not have a day-to-day understanding of that is very important to your future ownership of the property. For example, if on the borders of your property there you see 3 fences that pretty much enclose off the side and back of your property, you would think that that is all your property. Anything that within the fence is your property. But based on the survey, those fences may be encroaching on your neighbor's property, or may cut off property that is actually yours and you have the right to own. So that may be a big impact. For example, if that fence that you thought was yours is actually your neighbor's, and it was placed 10 feet on your property, suddenly, depending on how far it's placed, how long it's been there, there's a lot of other questions that may pertain to your specific situation, but you may lose out on a large portion of land that may otherwise be yours, that may run into zoning complications, that may cause issues with your lender. So without getting a survey, you're exposing yourself to a lot of potential risk and not knowing the true boundaries and details that affect your property. So typically for closing costs on the seller side, your main closing cost responsibilities is going to be the transfer taxes. So you have the state transfer tax, and you have, if the property is in the 5 boroughs, the New York City transfer tax. Of course, pay off any outstanding mortgages that are on the property from when you purchased the property. And then you're going to cover the costs of your own agent and any commission split that they have with the purchaser's agent. So you're responsible for that end of the cost. As far as purchaser's closing costs, you're going to have usually the biggest chunk of closing costs is going to come from the mortgage tax. So if you're borrowing money, then you have to pay the tax to have that essentially recorded. And then if you don't have that mortgage tax, the other costs may include the title searches, municipal searches from title side, your new survey costs, and cost of the title insurance policy. So all those put together. During the final walkthrough, while you can hire a home inspector, usually it's the case that I don't see that as necessary or something that most of my clients do unless there are significant changes to the property. So the home inspector, the first time around before you sign the contract, is already giving you an in-depth look of the condition of the property, and you have that report. Typically for a final walkthrough, you're just going 1, 2, maybe even 3 days before closing, just to make sure the condition of the property really matches what you saw and expected when you first saw the property with the initial home inspection. If everything visually looks about the same, there's really no need to go ahead and get a home inspector to sort of address anything. And then that's typically the most common outcome when purchaser does a final walkthrough. Everything about looks the same. They just want to make sure that the seller has indeed moved all the belongings out if there's no post-closing possession, that everything is pretty much in the condition that they expect it to be when they go ahead and close and take title to the property. Sometimes we see, for example, if when the seller is moving, damage occurs to the property, or if there's really things that were beyond expectation, something happens and there's now like a huge hole in the wall, or during a final inspection, they see a lot of garbage being left, let's say in the backyard, or between the time of contract signing and time of closing, a tree fell down and knocked out a damaged portion of the property. So really big ticket items that are beyond the normal scope of what we see, that it doesn't hurt to get, I wouldn't even say a home inspector because that's much more generalized, but maybe even a specific contractor to really look at what the scope of damage is, and then you can sort of address prior to the closing table, look, this is the condition I saw the property when I signed the contract. This amount of damage has occurred before closing and from what we just saw. So we need to sort of adjust for this damage in the purchase price, or make some sort of adjustments, concessions, and that's sort of like an ongoing dialogue between the purchaser and seller to ultimately come to a conclusion on what's reasonable between the parties.